Welcome to the Byte-Size Brief. Today we are putting JD completely under the microscope. Let's get into it.
Absolutely. It's definitely one of the most interesting setups in the market right now.
It's wild, right? I mean, how does a company generate over 44 billion yuan in pure free cash flow, sit on way more cash than debt, actively cancel over 6% of its own shares, and, still have Wall Street sprinting for the emergency exits?
Yeah, that is the big question.
Because as of today, April 10th, 2026, the fundamentals are practically screaming one thing, but market sentiment is it's screaming the exact opposite.
Right. And to figure out why that disconnect exists, we are pulling from a very fresh stack of data today. We're looking at the newly released Q4 2025 earnings transcripts from JD Management, some highly critical Wall Street updates, specifically notes from Morgan Stanley and Bank of America, and some recent supply chain intelligence regarding their European expansion.
Which is a huge piece of the puzzle.
Exactly. So our goal in this deep dive is to figure out if the market is just overreacting to short-term noise or if the underlying business model is fundamentally fracturing.
Okay, let's unpack this, because I'm looking at their balance sheet, and they seem to be swimming in cash. It's a mouth-watering setup for a value investor.
On paper, yeah, it looks fantastic.
I mean, they are trading at a PE ratio of just 7.78x.
Yeah.
And they just completed a staggering $3 billion share buyback, right?
Yeah.
Plus, they have a $1.4 billion dividend payout, which yields roughly 5%. How does Wall Street look at a cash-printing machine like that and just hit the panic button?
Well, what's fascinating here is the panic isn't really about the cash they have today. It's about the capital they are going to have to burn tomorrow just to tread water. Institutional players hate uncertainty, and right now they are modeling for some severe margin compression.
That explains the downgrades.
Right. Morgan Stanley just slashed their price target for JD down to $22 with an underweight rating, and their analysts explicitly stated that the worst is not behind us. Bank of America also cut their adjusted net profit estimates.
So what's driving the fear exactly?
Their primary concern is that JD is getting dragged into a brutal war of attrition. They're handing out heavy consumer subsidies just to maintain their market share, and that's happening alongside persistent losses in their food delivery ventures.
So basically, it's kind of like finding a mansion on sale, but realizing the roof might be leaking.
That's actually a pretty good way to put it.
Hold on, how does that actually affect JD's stock price for regular investors like me?
It affects the stock because the market is punishing JD for things that are somewhat out of their control. There are major regulatory headwinds in Beijing right now.
Ah, right, the regulators.
Yeah. Chinese regulators are stepping in to prevent major platforms from pressuring merchants to offer steep discounts. So JD is trapped. They have aggressively discounting rivals, stealing market share on one side, and regulators threatening to cap their pricing strategies on the other.
Okay, so compared to last quarter, what actually moved the needle here, like in the actual Q4 2025 numbers?
Well, the clearest deterioration was in total product revenues, which dipped by 3% in Q4.
3% doesn't sound terrible, but I'm guessing it's concentrated somewhere?
Exactly. It was heavily dragged down by a sharp 12% decline in their historical cash cow, which is the electronics and home appliances category.
Oh, wow. 12% is a big hit.
It is, but management pointed out that it's partially a tough year-over-year comparison base. But the metric that truly spooked Wall Street was the operating margin in the JD retail segment.
Did it drop?
It essentially paused. It flatlined at 3.2% because management actively chose to pump money into price-matching subsidies to fight off those competitors we talked about.
Right. But to be fair, I want to highlight some of the bright spots.
Yeah.
Because overall, Q4 revenue still grew 2% to 352 billion RMB.
Yes, that's true.
And general merchandise, like supermarkets and healthcare, surged 12%. Logistics revenue jumped 22%. So they're definitely diversifying away from just electronics.
The revenue diversification is critical, but there's an even more important efficiency gain that Bank of America pointed out. JD's food delivery losses actually narrowed by 20% sequentially from the previous quarter.
Oh, wait, really? I thought the food delivery was a huge cash burn.
It was, but they are successfully finding operational efficiencies there. They are getting better at scaling it.
Okay, well, here's where it gets really interesting. Because domestic appliance sales are facing this high baseline, JD is aggressively hunting for growth overseas.
Right, the European expansion.
Yeah. They launched the Joybuy app in the UK, Germany, and France. And they just made a massive 1.67 billion euro takeover bid for Seconomy AG.
Which is Europe's largest consumer electronics retailer, for those who might not know.
Exactly. But what I find fascinating is the strategy. Because, instead of doing this asset light, direct from China dropshipping model with 2-week shipping
Like
times,
a lot of their peers do.
right. JD is going incredibly asset heavy. They have 60 local warehouses in Europe right now. They're offering same-day delivery for orders placed before 11 a.m.
It's a completely different playbook.
And it's working. I mean, Joybuy is sitting on a 4.7 out of 5 Trustpilot score. That's insane for a new cross-border app. They are focusing on premium global brands like L'Oreal instead of cheap knockoffs. And they are undercutting Amazon Prime with a £3.99 a month Joy Plus subscription.
Which is a brilliant maneuver. And they are doing this by capitalizing on a major vulnerability in the European market.
What do you mean?
Well, legacy European carriers, like Royal Mail and other national postal services, they are bogged down. They have heavily unionized workforces and deeply outdated IT infrastructure.
They just can't keep up.
Right. They have universal service obligations that bleed their free cash flow dry, so they can't fund technological upgrades.
Right, but what does all that actually mean for JD investors?
It means JD has a massive durable cost advantage because they are doing an automation pivot. They are entering Europe with a clean slate using automated guided vehicles and unmanned forklifts.
Robots.
Exactly. In their Poland facility, the system increased operational throughput by 250%, and it slashed localized labor costs by up to 60%.
60%.
Right.
That is a massive margin protector in high-wage countries like Germany and the UK.
Absolutely. And if we connect this to the bigger picture, that massive automated infrastructure isn't just for delivering consumer retail goods.
Oh, right. The B2B side.
Yes. The Joy Express network acts as a Trojan horse. By building this world-class network, JD Logistics, which, by the way, saw 24% service revenue growth in Q4, can now sell third-party logistics services.
Wait, to other companies?
Yes. They are selling 3PL services to European corporations who just can't afford to build their own automated supply chains.
So basically, it's kind of like they built a superhighway for themselves, but now they're charging everyone else tolls to drive on it.
That is exactly what they are doing.
But wait, isn't there a huge risk with that?
Yeah.
Because competitors in apparel are getting absolutely crushed by these refund-only policies and like 80% return rates.
Yes, reverse logistics can destroy a company, but JD handles this differently. This physical infrastructure is backed by an AI-driven supply chain.
How does AI stop a customer from returning a sweater?
They use highly personalized sizing algorithms and predictive routing. The AI analyzes historical return patterns and cross-references it with the exact laser-measured dimensions of a garment sitting in the automated warehouse.
Oh, wow.
Yeah, so it flags high probability returns before the item is ever shipped. This vertically integrated AI-managed inventory, which they call the 211 blueprint, allows for strict quality control and predictable fulfillment.
So what does this all mean? It means JD is playing a long-term capital-intensive game,
Very long term.
and it creates a massive barrier to entry for competitors.
Exactly. So, to summarize, JD faces undeniable short-term pain, right? They're dealing with a sluggish domestic consumer electronics market and heavy upfront capital expenditures.
But on the flip side, you're looking at a 7.78x PE ratio, massive cash flow, and this incredibly highly automated, asset-heavy expansion into Europe. It's a really unique value proposition.
It really is. And I'll leave you with a final thought to consider.
Yeah, go for it.
With legacy European carriers bogged down by union costs and outdated tech, could JD's automated clean slate approach eventually make a Chinese e-commerce giant the default logistics backbone of Europe?
Wow. That would fundamentally change global trade.
All right, listeners, what's your take on the future of JD? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Bite-Size Brief.